Hello, everybody, and welcome to the IC Markets video commentary for the week of November 3rd. My name is Toby Gennaro from Trade with Precision, and we're going to get to the charts here, take a look at some of the equities, the S&P 500, see what's going on there. We've had a lot of action as of today with Fed coming out and the raising of interest rates. So let's go ahead and see what the technicals look like and see if we can maybe predict where some of the lows might set in on this market as the economy kind of goes into a little bit of a recession, and see if that's going to be a soft landing or a hard landing, maybe what that's going to look like and what the price action can tell us. So in looking at the US 500, which is the S&P index, I've got both the monthly and the weekly. So we're looking at kind of a longer term time frame here to kind of predict where things are going to potentially land. And so what I like to do is use the Fibonacci retracement to get kind of my bearings on where things might be. And so we'll first do on the weekly chart, we'll set up this Fibonacci right here. And I like to do what's called a Fibonacci cluster, which means I use multiple Fibonaccis to figure that out. And what I like to do whenever we're in a downtrend, so we have lower highs, lower lows, we just broke through the higher low. And as you know, most markets when they have higher lows, whenever you break down through a higher low, that trend is weakening. It's broken. Also, when you see higher highs in the price and lower highs on the indicators, you have divergence, which means that is a very bearish signal. The trend is weakening, and it gave us that signal way back in January at the beginning of this year. So only until it broke through that low really gives us the confirmation that more than likely, look out below, we could be in for a downtrend, because that hasn't happened in quite some time. If you scroll back through, the charts, at least going back 2 years for when the pandemic broke out. So since we're in a downtrend right here, we've got all the moving averages rolled over, the 50, the 20, and the 10. And every time price action rallies back up into the moving average zone between the 10 and the 20, sets up a bearish candle, and it is rolling over. This was one aberration right here. And then we rolled over to a new low. I'll show you where that 3,500 level comes into play as well, and how we can better predict that. But once we came down and set in that low and then bounced off of that, we bounced up almost perfectly right into that 50% retracement level like there. I mean, just almost right on the dot. And it set up, I thought it was going to set up a rejection candle right there, but it didn't. It actually waited for the Fed minutes to come out today. And then it set up that big bearish candle right here. My thought here is that we're going to break down through this low at 3,500, and I think there's a little bit of room here to the downside. Let's see if I can try to predict that and see if I'm going to be accurate on this. Let's put in another Fibonacci right here, and I'll show you what this does. If we can get some of these Fibonaccis to overlap, it's a really good way to use Fibonacci. I find it's one of the best ways for me to use them in my trading. So looking right here, we can see that we have that 50% level right there on the first fib, and then almost dead overlapping it is the 38% drawn in from the next higher, lower high to that same swing low. And so whenever we get overlapping, and it's also overlapping on a couple of key levels right there, you can see how there are a number of closes at that level and a number of touches actually from both sides, which makes it a very significant level. Whenever we get multiple fibs converging and overlapping right there, along with price action, support and resistance tested from both sides, that's a pretty good price barrier for price to rally up into that zone between the 50 and the 62%, and then to sell off of that zone. And oftentimes it does that around major news announcements and other things like that. So that's what I'm looking at on the weekly chart. So at least I know when to be cautious on the markets. If sellers are going to come into the market, they're going to do it right there. If the market's going to continue higher, I want the market to prove itself before I put my hard-earned money at risk. Here is what we're looking at on the monthly chart, right? So the monthly chart has been in an uptrend for the last 14 years since 2000, basically 2009, right? And so right here we have lower highs, we have lower lows. Put in this low right here. And what I'm going to do is put in another Fibonacci on the monthly chart. And basically, I'm going to draw this in all the way back from the pandemic low when we had the market crash back to 2180, and then we had that incredible rally. Remember all the tech stocks and everything supposedly supporting the work from home strategy. When I draw that to the most recent high, which is right around 4,800, and look for the pullback, what do we get? I put together a zone for myself between around 3,200 and 3,500. And lo and behold, it hits dead on the 3,500 number and then starts to rally off of that. But I think it's just, for the most part, going to be a bear rally. And that puts us right back into that range where we sell off. If we break the low of this candle at 3750, I think we're either going to retest 3,500 or more than likely come down here to around the 3,200 level and look for some key levels like router right around there where we might get some bottom in the market. I'm thinking even somewhere around 2,900 potentially could be a key level thereabouts. So that's kind of my analysis, I think, on where the market's going in terms of equities. I don't think it's wise to get long at this point, but that's just my personal opinion. But these are some of the technical things that I'm looking at. So I hope that technical analysis helps. Have a great rest of the week trading, and we'll look forward to talking to you next time. Take care.